Uh-oh, that's a discount. That very much looks like a discount there, but not to be worried about, right? We will see it, we will demystify it, and you should not be concerned. So if Stark Inc. issues, we're going to keep using the same examples, right? 1.5 million. The bonds, January 1st, year 5, same dates, same everything. I like comparables, right? We can just compare each question. We change one thing, what happens? So at 97, we know it's at a discount because of that. And right away, what am I thinking? Well, the cash we're going to receive, it's 1.5 million times 0.97. And that's going to give us our discount, right? The amount of cash we're actually receiving is only $1,455,000. And this is the journal entry at issuance, right? This should be super straightforward, super coming to your mind as soon as you see the question. You know exactly the journal entry to put, right? Definitely the accounts. You're always going to debit cash, always going to credit bonds payable, and then you've got your premium or discount. And this is the unclean number. This is the clean number, right? There's always going to be a clean number. This is the number that you multiply by the percent that the interest rate is going to use. Now, what do we do for our straight line method of amortization? Here, this is still a relatively simple one. That's okay. As we're breaking into it, there's a lot to say. So assuming we use the straight line method, we are going to amortize $2,250 for each period. Now, this is the straight line method. Normally, what you will do is the effective method. And if any of you have seen this before, you're probably familiar. Well, you're not going to do the same amount each year. You're going to do it and keep adding it back and getting up to the amount, right? But we'll see that in a bit. No worries. Just take it one step at a time. So what we do here essentially is because it's at a discount, it's a lower value than the face. We're constantly bringing it back up to the original value. So the original value is 1.5 million. Here's our discounted amount, and each year, each period here, we're going to keep adding back 2,250 and back to, and then basically we're amortizing, we're bringing it back up to 1.5 million. Now we're going to see with the premium, we're going to subtract it. We're going to subtract out this inflated cash amount and bring it back to the 1.5 million. That's this whole process. That's the process of bringing your carrying amount of the bond back up to the face value, the fair value, right? So let's keep moving forward. You are seeing it here, and you're going to do quite well with it. All right, now we are still dealing with our bond discount, but in this case, we have our first semi-annual interest payment on the bond discount. Okay, well, this is when we start to amortize the bond, right? This is when we start to amortize it. Well, we have our debit to interest expense because, well, what's happening? We owe interest. The amount of money we're actually paying, though, remember, that's going to be interest payable, right? This is going to have to do with our balance sheet. This is the income statement report. This is what's actually happening. Discount on bonds payable. This is for our straight line method, right? We do have the effective method. We'll see those in examples, but we are going to credit our discount on bonds payable to reduce overall the net effect, because originally we debited discount on bonds payable. So now we're going to credit it in total, and it's going to, at the end of this process, equal the total amount of the original discount on the bonds payable. And at the end of the year, here's our journal entry here. And the reason why it's interest payable instead of cash is because we pay on January 1st, right? So if it's one day later, sure, it would be this cash amount. But like I was showing you before, interest expense goes up, payable goes up, and then gets paid down. Goes up, and then gets paid down. Goes up, and then gets paid down. That's the process of the payable versus the interest expense.